Yeah, I remain very bullish. I've raised targets in the last few months. I just raised in April. I raised my target to 8,000 on the S&P. In my most recent third quarter letter, I raised it again to 8,700. So I'm clearly by far the most bullish on the street. I think we're in a final leg of a 43-year secular bull market. We've talked about that before, and there'll be pullbacks along the way. I think here probably one soon, but this thing's got plenty of vertical move here ahead before we get to any problems. It could be very fast. I'm saying this last leg will go parabolic as we move towards the top. So parabolic means almost vertical, very steep. So you can cover a lot of ground in a short while. Those numbers seem crazy until you get into them and see how fast this thing can move. So everybody wants to pinpoint a time. I've been saying it could happen by fall. It doesn't have to. Yeah, last April, obviously, when the tariffs were announced, they surprised the market in terms of how large they were and what Trump was in a negotiating pattern at that point. The market took it at face value and so this is going to tank the economy. This is going to tank the markets. And most strategists on the street, most market analysts turned bearish at that point. You start hearing the top is in. We aren't going back to the top. We're heading for 4,000. We're heading for 3,000. And right under, at 4,900, 5,000 is when I raised my target from 7,500 to 8,000 on the S&P and raised the other indexes. I think I raised the NASDAQ from 23 to 25 at that time, or 25 to 27. And but my thing was that everybody got so bearish so fast. Sentiment was actually back to levels in 2020, at the lows in 2020. What I saw there was that we rebuilt the wall of worry in a very short time, in a matter of a couple of weeks. And everybody was on the wrong side, and I got more bullish in my typical contrarian approach. So, I think we basically rebuilt the wall of worry. That wall of worry is the fuel for this final leg. 30% off the lows. You have a good deal of skepticism. People say, well, that's fine. We had another run, but they thought it was going to be a double top. It blew through that, which I said it probably would. And now they're looking and saying, gee, I don't know what to do. But they certainly aren't bullish. They are, some are kind of coming on board and going with the momentum a little bit, but there's still a lot holding back saying, I want to pull back. Yes, maybe this thing has more to go, but I want to pull back. But it's not a given. I mean, those short-term scenarios may or may not work out. Given the skepticism that's still in there, you saw the reaction yesterday to the Fed. This thing may just kind of keep rotating and feeding on itself, so that you could get a pullback back to the breakout, which was 6,100 area on the S&P, which would be 6 or 7%, maybe 5, 6, 7% pullback. That would cause a lot of people to get bearish again. I think even that little pullback, given how far we've come, could cause people to say, oh my God, we may have seen the highs. And that would just be, again, we'd be rebuilding that wall of worry. Or we could just see that this thing is kind of in a rotating correction where, different groups kind of correct. For instance, the small caps, which started to go, have pulled back again here. So it remains to be seen. I don't have a crystal ball to tell you whether we'll get a pullback or whether we were kind of getting a sideways consolidation in here. But either way, I think the next few months is up. You could have a 2 or 3 week pullback, or you may not. Basically a 3.5 month consolidation here at a high level, between 3,200 and 3,400, 3,500, I guess. At the present time is more in the lower end of that consolidation. I don't think there's much downside here, if any. And I think basically you'll have another leg up here. I have a 4,000 target on gold. I can't remember exactly when I raised it, but since I talked to you last, I think I raised it from 3,400 to 4,000. And I think that's what we're probably going to see this year. So sometime between now and the end of the year, you should get up to that. Silver's a little more volatile, as we know, and scares people out oftentimes because of the volatility. It ran dollars and looked like it. I think my next resistance level is the mid 40s, 44, 45, and not sure what it does there. Whether it has a bigger pullback or kind of very short term stalls out and pushes through there. My target on silver is 75. We could see that by the end of this year or certainly early next year. I don't view this sell-off as violent as it may seem to some that we've come back from 39 to up to 36 and change. A month ago, silver was down in the 33 and a half area, 33 and a quarter area. So we're at the end of the month. It's the last day of the month. It's not unusual for these metals to fill in, and actually other markets too. So people have to be careful not to react to day-to-day stuff. If your low last month was 33 and a quarter and you're at 36 and change now, and your high last month was lower than the high today, you're still putting in higher lows, higher highs. And I think August will probably be another bullish month. So silver looks great to me. I think the miners are finally, although they are again volatile and cause people to get nervous, they're in uptrends that will continue. Over our SIL, which is large silver miners, to 75. I think that's on track, and SILJ to 35. Which is a long way from here, but I think you could see that this year. So on gold, GDX, I raised my target, had been for a long time 65. I've raised that to 75, and my GDXJ, which is junior miners, remains at 100. It's a very clear target there that I think we can get there a little above that. So I'm very constructive on both the metals and the miners. Yeah, it's not, I think we'll get to that old high at 49 change or wherever it was, 48 change. And push through that. And once we push through that, you'll see some pretty fast moves, I think, up to 75. So, it doesn't mean it's going to happen in the next 2 months, but I think in the next 6 months, you certainly could see it. It plays a role in the big picture. I mean, I think the pro-growth policies we're seeing out of this administration, deregulation, the bringing manufacturing back home, getting these deals where you're actually going to get foreign investment in this country that's controlled by us, that we can kind of decide where to put that investment. The immigration policy where you're controlling the border again, and tax policy, the big beautiful bill. All those things I think are going to feed into a long-term story, meaning post-bust, because I'm still calling for a global bust next year. But post-bust, I think those things are constructive to the economy, will be part of the story afterwards. People react to various things in geopolitically as well as economically, and it can create some volatility there. But basically, I think the story, as I say, the bust, in my opinion, is baked in the cake. It's not the result of Trump's policies. It's the result of decades, and I mean many decades of misappropriation of capital, cycles that got overheated and then got tightened down too far. And so what you've had is this ratcheting up, kind of a natural thing in the big cycle, in what I call a super cycle, a little bit more extended, and therefore takes more policy to crank it down. The excesses get greater. It takes more policy to crank those down. Then you go and overdo it on trying to get you out of that hole, and it becomes another one. And what you get is, I think somebody called it a buggy whip type of action, or a sine wave, I'm not sure, but where you get these steeper cycles. And so 2008-9 was our biggest post-depression, downturn and the crisis, financial crisis. I think we're going to see an even bigger one this time, where you go to these extremes on the market and then you come down. I'm calling for an 80% bear market from the peaks. We haven't seen anything of that magnitude since the Great Depression, since the 29 crash. But we're in these excesses. Leverage is so far off the rails. We had tremendously high leverage in 2008-9, which gave us the Great Recession and the huge financial crisis back then. We have debt way beyond those levels now. Global debt's at $330 trillion. We have derivatives that are so much larger than, greater than what we saw back then. So debt is leverage on the system, on the economy. I think both of those things, when we turn down, will exacerbate the downturn and make it greater. So the fact that it's many, many degrees greater in leverage than 2008-9 simply means, to me, the likelihood is that we're going to see a bigger downturn, a bigger financial crisis than we had then. Different. I mean, we don't have the subprime issue that we had then, much less. I mean, we've really taken that leverage out of there. But around the world, this is a global bust, and around the world, there is just so much more leverage, and banks that are fragile and vulnerable. So it may not start here; it may start elsewhere this time, but it will take in the whole globe, I think. Yeah, I can't say deeper than 80%. That's pretty. That's pretty. I don't have a crystal ball to be able to know whether it'll be something larger than that or something smaller than that. But 80 is kind of as a pretty severe, once in 90 year type of crash. So I'm not looking for AI to make it bigger than that, but I think AI will certainly contribute to that. And you're right. I mean, there's an awful lot of speculation and valuation being driven to the sky on some pretty rosy expectations. And a lot of those expectations obviously won't play out in the short run. AI is certainly here to stay, and AI will contribute to whatever those next cycle looks like. My big thesis is, as I say, macro trumps all of that. And the macro is this, this huge leverage that takes us down sharply and leads to a massive responsible fiscally and monetarily beyond anything we could ever have seen, we've ever seen before and could ever imagine. I'm using, just as a seat of pants number, say 20 trillion out of the Fed in QE, new QE, that will take to pull us out of the tailspin. We were up to 9 trillion. We did from 3.7 to 9 trillion in the 2020 response. And prior to that, in the 2008-9 response, we went from 875 billion to 3.7 trillion over a course of several years. So to say that we're going to go from, we're basically 7 trillion now, I think, to go from there to 30 trillion, let's say, in response to this downturn, it shows you how much further beyond, and again, I could be wrong, but that's kind of what I see building up. And those kind of numbers, we use trillions, like we used to use billions, like we used to use millions, but those are huge numbers that we have never, ever seen before. They blow away anything. What it means is that's the huge story. AI will be a sideshow to that, although AI will play a role next cycle. That macro, that massive and that massive money will be accompanied by maybe not as big as that, but a pretty massive fiscal response. That means debt's going to go even higher next cycle, as we come out of the bust. So we're at 330 now, we could be at 450 or 5 by the end of the decade. 500, from 330 to 500 trillion in debt. I mean, those are numbers we throw around, but they're mind-boggling. They're beyond anything that you can really comprehend what that means. So it's hard to see where AI can compete with. So that's a good offset to what I think this massive money is going to lead to with a lag. It's not going to happen in 27. It's probably, you're going to see the bulk of the inflation late this decade, 28, 29, 30 and beyond. But I think what it ultimately leads to is inflation above 20%, maybe 25% in this country, hyperinflation around the world, and debt that has to be financed with interest rates that will follow the inflation. So if rates could get to zero, the 10-year could get to zero next year in a bust. If they start at zero, they could go to, if inflation goes 25%, the 10-year could go to something close to 20%, high teens to 20. Massive debt that we'll have as a result of that. That's why I say macro trumps everything else, even trumps Trump, because his pro-growth policies are going to give us some of that boom, but that boom's going to come with huge commodity inflation. As we build factories and plants and equipment here, it's going to require a lot more commodity input than we have supply for, and that means you're going to have demand way outstripping supply and prices going through the roof. Just oil, which is a favorite of his, obviously, and I think we're in a bear cycle in oil. I think oil goes to $30 in the bust, but from there, I think oil can go to $500 by early next decade. That's what inflation means. That's in real terms. That's what you'll see. You'll see copper go from maybe $1 or $2 in the bust to, who knows, $20, $30. I don't know where copper goes. Silver will go to 500. Gold will go to 20,000. That's what, in real terms, when I say 25% inflation by early next decade, in real terms, that's what it'll translate into commodities, and obviously commodities flow through to consumer goods and everything else. So the consumer is going to be facing some tremendous headwind. Standard of living is going to be hit pretty hard, I think. Hopefully, I'm wrong on some of that in terms of the extremes. Hopefully, Trump has some policies that can ameliorate some of that. Some of their plans to try to reduce the deficits, and certainly growth will help the deficits. I don't buy the deficits that were being sold right now in terms of static analysis. I think Trump is right that you can grow some of your way out of those things, but once this thing explodes out of the other side of the bust, it's hard to see any policy being able to offset that.